Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Dode, and today's guest is a new guest. His name is Eric Hadik. He is the editor of the Inside Track and 40yearcycle.com. Eric, thank you for joining us.
Thanks so much for having me, Mo. It's my pleasure.
No problem. Actually, you were brought on as a guest due to popular demand by our listeners, so we're glad to have you.
Oh, it's nice to hear that.
So before we go into the discussion on what's going on in the economy and the market, I just want to take some time to discuss about your background and your approach to trading for people that never heard of you.
Well, I got introduced to trading back in actually late 70s, early 80s, just as I was finishing high school, and started trading the futures markets and have been really intimately involved with them ever since. I have come at it from a technical and cyclical basis or perspective, and have just been continuing to build on that the last 30 plus years. So
you have a focus on looking at cycles. So when you talk about cycles, do you mean looking at what happened in history related to the economy and the stock market and try to make a prediction based on that, or is it something a little different?
It's actually all of the above. I'm definitely intrigued by and constantly studying just the recurring rhythms in our world, in our markets, and just how uncanny so many of them are. And then formulating trading strategy around that. I do not advocate trading just off of cycles, but they provide a very important backdrop for my trading and my analysis that then needs to be taken down to a more practical and risk-defined standpoint. But I look at everything from cycles in the markets to cycles in geopolitics, even cycles in things like geophysical events, meaning earthquakes, volcanoes, and cycles in solar, not just sunspots and solar storms, but how they impact things on Earth going back hundreds of years and narrowing that down to a more usable bit of analysis. So I do study and apply cycles to a vast array of vehicles.
And one of the things I've learned about investing over the years is that there's many ways to invest in the stock market. There's people that just look at technical analysis, that just look at the chart. There's people that just do fundamental analysis, or they do value investing, or they do something like you're doing right now. So there's many ways for people to learn how to invest, and that's a great thing.
Yeah, and I think that the key is to recognize the strengths and the weaknesses of each approach, and to just work around them or emphasize the strengths and try to avoid the weaknesses. There are definitely some weaknesses to technical and cyclical analysis that I've tried to really incorporate specific indicators that help alert me to when they might not be as reliable. But then you also look at things like fundamental analysis, and really I'd say two of the biggest weaknesses there are advanced timing, that usually when people find out about a fundamental, it's already factored into the market, that somebody knew about it before the masses. And so even though that fundamental might move the market, it's kind of a moot point because the average investor hasn't been able to capitalize on it. And the other weakness where fundamental analysis is concerned is risk definition, being able to really pinpoint where a specific market or trading vehicle is not adhering to that fundamental, and where you're wrong, and where you can limit your risk and just get out and live to trade another day. So with all of those approaches, I think that's really the most important thing, is to understand and to recognize the strengths and weaknesses and make your decisions accordingly.
Yeah, and we're never going to be 100% right, but it's good to find a system that people are comfortable with and they have have success in doing.
Exactly, and that's, I'm not so naive that I think technical and cyclical analysis are the holy grail. Really, when it comes down to it, they are for lack of a better definition, they're a numbers game, and you're just trying to play the odds, so to speak, letting your profits run and cutting your losses short. Even though that old adage may sound kind of cliche, there's a lot of truth and importance to that. And so if you can make the most out of those winning trades and be able to identify when you're wrong and get out of the losers, then over time, the numbers and the odds should work in your favor if you have an effective and a credible trading program.
Right. And looking at the cycle that we're in right now, can you think of any other time in history where countries all around the world are in a currency war where they print as much money to debase their own currencies in an effort to enhance their own economy and enhance the export market? And also, we have central banks all around the world printing a lot of money and creating a super debt cycle of what people had been calling it. Have we ever been in this time before in the past?
I don't believe so, and I think that's even just a simple result of the not just the importance, but the proliferation of currency and of fiat currency in our current world, but there has definitely been a consistent rhythmic ebb and flow where currency is concerned, and I've really written on this for over a decade, but in my opinion, one of the most consistent and most accurate cycles of that vacillation is a 40-year cycle, and I trace it back to the beginning of our country, the beginning of the United States, and even well before then, going back to even some of the earliest currency in the mid 1200s, and then forward to the late 1600s when the Massachusetts Bay Colony had their first experiment with a paper fiat currency. And then 240-year cycles later into the 1770s when, while going through the American Revolution, we experimented with the Continentals, another paper fiat currency that plummeted from 1775 to 1781. Basically, the Continentals lost their entire value and were discontinued. And every 40 years, you have this battle between centralized currency control, which is often a paper currency, versus a hard money, gold, silver, other type of hard backing that has just, like I said, it has been uncanny in how precise the timing has been. 40 years after that experiment with the Continentals I mentioned in the 1770s, you had the 1810s, and there was a battle over the rechartering of the Second Bank of the U.S., and Thomas Jefferson spearheading the battle against that and warning of all the evils of a centralized controlled currency. And then 40 years after that, in the mid-1850s, you had the government in the U.S. First reducing the amount of silver in coins, basically devaluing the currency, and then by 1857 suspending it. And then 40 years later, in the 1890s, you had a massive battle over currency and over a gold standard. And you have William Jennings Bryan and the famous Cross of Gold speech, all right in that, really 1896 was that battle. And 40 years later, you had the confiscation of gold and silver in the 1930s. And all of that kind of culminated in the 1970s with first the Nixon gold shock and then the collapse of Bretton Woods. And all of that led to the Jamaica Agreement in 1976 that was basically a divorce decree between all of the world's industrialized currencies divorcing from gold, and that from that point forward there would be no remaining link to gold. And to me, that ushered in a final 40-year cycle of testing, of preparation, and that's why I focused that and a lot of other things. That's why I focused on 2016 as why I thought gold would come back to life and you would see the beginning of the end for a lot of fiat currencies. And I'm looking at 2016 through 2021 to be that overall cycle. But it's one that has just kept recurring on such a consistent rhythm that it's hard to ignore, and investors can ignore it at their own peril.
So I want to get into gold a little later in the podcast, but first I want to talk about a current event that happened pretty much today, June 24th, the day of our recording of this podcast. As you know, the UK had voted to leave the European Union, and in result, the market went down at one point 500 points. Gold and silver went up. At one point, gold was at around $13.20, and silver was above $18. And right before the podcast, you told me that you had an expectation that Britain would due for another financial currency crisis in 2016. I just want to get your thoughts on the current event that happened in the UK today.
Well, I think the vote for Brexit definitely validated cycles that I've been writing about the last couple of years, and even last month, my monthly newsletter, Insiide Track, was focused on these cycles in Britain. Did some articles for some other magazines too, really emphasizing that same thing. And the thing is that not only can you trace a very consistent 40-year cycle in Great Britain, and on that note, 1976 was not only the Jamaica Agreement that I mentioned before, but 1976 was one of the most significant low points in Great Britain's currency history, when they had to go to the IMF pretty much hat in hand and ask for a bailout of their currency. The British pound saw its lowest low set in June of 1976. It plummeted into that time frame, and here we are, an exact 40-year cycle later, June of 2016, and I was looking for the pound to plummet again. Well, overnight, we spiked to the lowest low seen in the pound since 1985. So it is just perfectly fulfilling that 40-year cycle. But when I was really detailing that, I was showing how there are even more shorter-term and more contemporary cycles that have governed Britain and currency crises that they have experienced every 8 years. And for anyone that trades the stock market long-term, they're probably familiar with a very consistent 8-year cycle in just the stock market, so just validating that actual cycle. But where Great Britain is concerned, they have had just a very consistent, almost uncanny sequence of attacks against their currency and just all-out economic debacles on an 8-year basis, going back for really the last 40, 50 years, even going back to 1960 when they first started the European Free Trade Association and tried to compete with the developing EU. At the time, it was the EEC. And then in 1968, when they had an all-out financial crisis, 8 years later, in '76, was when the pound was pummeled basically, and they went to the IMF for a bailout. 8 years later, in '84, they had a record high unemployment and their industrial output plummeting and the currency suffering as a result. And then 8 years later, 1992, was the infamous Black Wednesday, when George Soros almost single-handedly broke the Bank of England, speculating on their currency and selling it, which forced Britain out of the exchange rate mechanism in Europe. And that 8-year cycle just kept going and kept really inflicting debilitating blows against Britain's currency, their economy, their standing within Europe and within the world. 8 years later, in 2000, the pound was plummeting again, and it created just an inflationary debacle, with Great Britain having the highest gas prices in the developed world, which then triggered all types of protests and blockades, and 90% of their petrol stations running dry, and then food being rationed. And then 8 years later, they were right in the rest of the global meltdown, but there were also things. The pound had plummeted 35% in the 14 months from late '07 to early '09. So it's just this recurring 8-year plummeting in the British pound. And that's why I was writing throughout this year that I thought that we would see another dramatic drop in the British pound. And it just seemed to be indicating that they would certainly vote for Brexit, since that's the result that would trigger the most panic and the biggest crises looking out. And I think that the events of today are just a knee-jerk reaction. I think that there's going to be, once the dust settles and once some other unintended consequences start to emerge, that I think you're going to see some even bigger trouble emerge later in 2016. There's a specific time frame that I'm looking at, and then into 2017, which is when, if you go back and time each time the British pound finally saw a major bottom, it was also on an 8-year kind of a delayed cycle from when their crises occurred, but it saw major lows in 1985, 1993, 2001, 2009, and the next phase of that cycle is in 2017. But there's even a lot of bigger ramifications that I discuss, where in fact the articles that I titled one of them "An Empire in Decline," and showed how much longer term cycles in Britain coincide with just debilitating blows against their geopolitical structure, their empire, and it's so today's vote and these events are just another straw, another affirmation of those cycles. I don't think that it's the only issue. I don't think it's the do-all and end-all, but I think it's just another corroborating event that really reinforces these cycles.
Yeah, and a lot of people on mainstream are very surprised that the UK is leaving the EU. A lot of people were predicting that they would stay. I think the people in the UK are probably better off leaving the EU, but they're going to be short-term pain for leaving the EU. But in the long run, they might be better off. Well, we'll see. So you're saying that the pound in the late 2016 and 2017 will finally bottom. Is that correct? Yeah,
I think there's more downside to go before that, and often the final phase of a cycle is often the most dramatic. So yes, I do think it's got a major bottom in store for it next year, but that there is still more pain before then.
So what do you see happening beyond that time frame in turn for the UK?
Well, I don't focus that much on the UK themselves, other than these kind of bigger picture, longer term cycles. So I wouldn't feel comfortable speculating on specific geopolitical events, but it does play into what I have described for probably the last 15 years, and that deals with long-term cycles of that kind of link this European unification. And my conclusion has been that from 2014 to 2017 or 2018, you would see some serious blows against European unification, and that would usher in a revamped unification in 2018 to 2021. So basically, I think there has to be a whole restructure there. And I don't know exactly what that will look like. I'm not an economist, and so, you know, a lot of the specifics of that, I don't know. But for me, it's critical to try and discern where a lot of related markets are heading as kind of a precursor to that, how to benefit and capitalize on that, but also to learn from it and to see what that might be auguring for the future. So I do think that there is going to be more pain in the whole European Union, and I think that that's really going to be one of the critical unintended consequences of this Brexit vote. Even if they had voted to remain, I think just the whole process has awakened a lot of other European nations, several of which are kind of split down the middle on whether they want to be subservient to a Brussels centralized bureaucracy that often doesn't appear to really consider their national priorities and expectations, and by many accounts, there's not a lot of accountability for the EU governing mechanism. And so a lot of countries are becoming very disenfranchised with that and having more nationalistic and independent feelings and sentiment well up in their countries. So I think that that's what you're really going to see over the next year or two is more movement in a direction similar to Britain. Whether those other countries will be successful, whether they go as far as Great Britain has, I don't know, but I think that that's going to be the general theme of this whole period leading into 2018, 2019, when I see some really dramatic seismic shifts in the geopolitical structure.
All right, so let's shift gears here and talk about gold. I know we talked about it a little bit earlier in the podcast. I was reading your publication in the past couple of days, and correct me if I'm wrong. Correct me if I'm wrong. But in 2012, you stated that the gold market would see a short-term correction, and in 2016 will be the golden years in which gold will finally bottom. And so far in 2016, gold has bottomed and has rebounded up about $300 since the beginning of the year. How did you come to that conclusion?
Well, there was a lot of factors driving that analysis, and some of it started with the bigger picture analysis. Back in 2011, I had done a series of articles where I was correlating the Nixon gold shock of August 1971 and saying that I thought the gold would see a multi-year top in August of 2011, exactly 40 years from that basically dramatic event. And there was other technicals and wave objectives, price targets that had been reached or were in the process of being reached. So it's the synergy of all those things that really leads me to more firm conclusions. But once that took hold, gold topped in August, September of 2011, and I thought we were going to see a multi-year period of consolidation, a pretty serious setback, and even at the same time, I was describing what I expected as far as a bubble and crash in silver. and silver peaked around $48, $49 an ounce and has dropped as low as spiking below $14 an ounce in 2015. But it would take me quite a bit to describe all of the factors that I was describing, but one of them is that 40-year cycle and what I was just talking about, the battles between fiat currency and hard currency, and I thought that 2016 would be the turning point, linked to many things, but also that Jamaica agreement, and that was really when gold entered its biggest surge in the 70s, was between 1976 and 1980. And again, tracing that back every 40 years, you saw very similar battles between gold and paper currency. But there was also more shorter-term work and also some geopolitical analysis and economic analysis that just drove me to say, first of all, that you should be waiting, as many of the gold bugs in 2012 and 2013 were saying gold was ready to go to the moon. My contention was that we were in this big corrective phase and that the gold bug should really wait till the end of 2015 or early 2016 to get back on board for a big move, and that the first 6 months of 2016 would see the most significant advance we've seen in several years. And so it was linked to a lot of those factors. And like I said, I'm not really doing it justice, trying to just hit a couple of the high points here, and it would probably take me an hour to describe a lot of the intricacies of my analysis for that. But it just went in line with this whole idea that I think we're going to see a seismic shift in currency and in economics and finance starting in 2016, and 2016-2017 really being the big transition watershed events, and then the secondary ramifications and repercussions playing out over the next 5 years or so. So it was all of this coming together, and just looking at 2016 as the year when investors were going to start seeing the outward manifestation of what I think has been going on beneath the surface for several years.
And a great call on your part, because gold and silver have done pretty well so far in 2016. So I think you probably answered this already. How do you see gold performing for the rest of the year? You believe that the gold will continue to hold the bottom and climb up further, maybe later in 2016. Is that correct?
I do think that the bottom is going to hold, yes. Okay. When you get down to more monthly and weekly cycles and analysis, I do that. My overall analysis for the second quarter of 2016 was to see an initial surge into late April, early May, and then another surge into mid to late June. And I think that we are kind of in the culmination phase of that right now, and that we'll probably see some very volatile consolidation start to unfold in the coming weeks and months. But yes, later on in 2016, I think we will set a secondary bottom, and there's some specific weekly cycles already pinpointing where I think that's most likely. But I think that would be the time to, for anyone that didn't get on board in late December, early January, or someone that's looking to add to gold and silver positions on a pullback, I think that's going to be the time to do it. And that then I do see a more sustained move up in 2017, 2018. And that also really dovetails with a lot of inflationary cycles that I have described, and even what I call food crisis cycles, that there has also been a very consistent cycle of inflationary moves in food prices, grains and softs and livestock, and that 2016, 2017 is when I expect a new phase of that to unfold as well. So they all kind of play hand in hand.
Okay, great. Well, that's interesting insight on the gold market and silver market as well. And for people out there that want to stay on track on what Eric is saying, you can go to his website at Insiide Track and subscribe. So I want to shift gears and talk about the stock market for a little bit. Now, you believe that the stock market will lose steam this year as well. Do you still believe it will happen? For the most part, as the market continues to hold this year, even though we had a period where the Dow Jones dropped a couple thousand points?
Yeah, I have been describing what I thought would be a parallel to how the market acted in 2000 through 2002. And there were, again, many reasons going into that expectation, but I thought that, first of all, the stock market was going to be topping in late 2014 and throughout 2015. That was an exact 40-year cycle, what I just talked about, an inflationary cycle in stock prices that began from the December 1974 bottom and really drove this whole stock bull market since late 1974. And not only would that be another recurrence of the 40-year cycle, but it would be an exact wave mimicking of the previous advance. When you look at the stock market from the 1932 low to the late 72, early 73 peak, the whole advance was just over 40 years. And the stock market was poised to do the same thing with a peak in 2015, rallying just over 40 years again. But again, there was a lot of things factored into that, but I thought that we would see a 1 to 2 year period, much like if you go back and look at a Dow Industrial chart in 2000 and 2001, where the stock market would see 2 to 3 month sell-offs. They would be pretty abrupt. They would get people kind of bearish in their perspective, and often would spike just below a key support level or a previous low. But then just when everyone thought it was going to break down and go into an accelerated decline, the market turned and headed back up for 1 to 2 to 3 months, and would almost reach the previous highs. And just as you were getting near those peaks, everyone would turn bullish, be talking about the market ready to go on its next phase into the stratosphere, and before you know it, the market turned and headed back down. And this happened for 15 to 18 months in 2000 to 2001 in the Dow Industrials. And I was looking for a similar pattern to unfold in 2015, 2016. And that seems to be what we've really seen with the sharp decline in June through August of last year. And then you saw a strong rally back into early November. Some indices spiked higher in early December, but they didn't take out their previous highs. Then you saw another sharp decline into late January, early February. Looked like it was going to break support, only to bottom out and spur another rebound almost back to the highs into mid-April. Some of the indices have retested those highs, but by and large, most of the indices set their highs in mid-April. And the next phase of that, I thought we would see an overall drop into late June, early July, with late June being the real vulnerable time for another sharp sell-off, just like we saw in late August and late January. They were just the reinforcing and the perpetuation of a 5-month cycle that has timed some very blow-off sell-offs and lows in the market. And late June, early July was the next phase of that, when I thought we would see another sharp decline. But I have also been saying that I didn't think we would see a sustained really damaging sell-off until late 2016 and then into early 2017. So it's one of these things where I certainly expect 2 to 3 month declines that provide some great selling opportunities and some intervening 1 to 2 month rallies that provide some good buying opportunities for traders that are more agile and are not looking to just buy and hold or sell and hold. But that there is a lot of volatility still expected, and it being a kind of a stair-step decline that's really going to frustrate investors. And just when they kind of throw in the towel or don't throw in the towel is when I think that you're going to see a more sustained sell-off, breaking some critical support levels later this year and into next year. So that still remains my outlook, and the action of the last 6 to 12 months has pretty much validated that outlook. So I continue to expect some similar action going forward.
And I mean, in your analysis, the 2016 election will also be wrapped up. So did that have any impact on your analysis at all, on what candidate get into the Oval Office or not?
It could, but I have really kind of shied away from that one right now, just wanting to see where some of the markets line up getting closer to that time frame. I think there are still more shock waves to come in the election campaign. There's an interesting dollar correlation that I described a couple months ago that tends to swing with Republican and Democrat administrations, but I don't have a strong conviction on the 2016 election, and even if it's going to, by November, look the same as things look right now.
Right. So in your analysis, you've been stating that 2016 to 2021 will be an important time period in the 40-year cycle. So for people on Main Street that are traders or investors, what should they be doing right now?
Well, that would really have to do with their time horizon and where they're trading. On 3 to 6 month and 6 to 12 month basis, there's a lot of differing approaches as opposed to someone that's looking at a 3 to 5 year horizon or looking to invest for retirement. It's very dangerous to kind of just throw out a one-size-fits-all analysis for that. But I definitely think, as I was saying leading into this year, that getting back into gold and precious metals was a key facet of a good investing approach. And also looking at things related to commodities, but you have to be really careful if you're talking about specific equities, because how they would be impacted by rising food prices. That's one of the key things I'm looking at over the coming years. But paper assets, I think, are in for some struggles in the coming years as hard assets begin to retake precedence. And it's the late 70s might give a little glimpse, although I think there's a lot of distinctions too, but of some similarities to what we could see a little later on in this decade. And so I think that you have to be very, very careful and very specific with what you're looking to do if you are in paper assets, and not just get married to those positions come hell or high water. So I know that's not real specific, but I do not like to give one-size-fits-all type of outlooks and analysis, because that tends to be misconstrued very easily. But if anything, I would just say the shift to to harder assets, at least in the coming years, is one of the key factors that should be implemented in a trading strategy.
Right. Yeah, and I agree. There is no one size fit all in the investment world. But with the fiat currencies in trouble, it is important for investors and traders to protect their wealth by investing in hard assets. So yeah, I agree with you there. Yeah. And then also, and yeah, go ahead.
No, I was just going to say the other thing that, you know, even when your gold bugs tend to get so enamored with just precious metals, that's not the only alternative out there either, because things are definitely heading in the direction of digital currency, and so there's a lot more. It's a lot more complicated than just a precious metals versus fiat currency. And again, you look throughout history, and there are different shifts and different things utilized as a harder or more consistent currency. And so just a buy gold and silver approach, I don't think is wise for the long term either, although I do think there's definitely some immediate opportunity there.
So when you say digital currency, you're talking about Bitcoin and all the other digital currency that's coming out right now.
Well, right? I think it will probably be some future variation of that. You know, the pioneers often kind of get slaughtered. Those initial companies and in this case currencies often pave the way for what's to come, but may not survive themselves, leading through that transition. But yes, something remotely related to that.
Okay, great. Well, Eric, thank you for your time. This podcast has been very interesting discussion, and people want to find out more about your work. If you don't mind, give out your website one more time.
Yeah, and thank you very much for having me, Mo. I really appreciate it. The primary flagship website is InsideTrack.com, but you need to know that that's got an extra I in the middle. It's InsideTrack.com. And also a lot of this 40-year cycle analysis can be found on our other website, 40yearcycle.com. That's the number 40yearcycle.com. And they can also contact us through that to get some free samples, some other information, but a pretty exhaustive description and examples of much of this analysis can be found on those two websites.
Okay, great, Eric. Well, thank you for your time, and we definitely want to have you back on maybe before the end of the year to just update our audience on your analysis on the cycles and and on your technical analysis as well.
Sounds great. I would love to come back.
All right, great. Well, thank you.
Thank you, Mo.